Well, hi everyone, Sean Humphries here. Welcome to All Things Retirement. In this installment, we're going to talk about the impact of declining interest rates, how it's impacted behaviors, how it impacts portfolios, and some strategies to begin considering when looking at your portfolio in the midst of very low interest rates on guaranteed investments. Now, if you're new to this channel, make sure you hit the subscribe button. We're posting content all the time, quite literally in All Things Retirement. For the last 30 years, we've been helping clients and families navigate the retirement decision-making and progressing into retirement on the preparation phase, the transition phase into retirement, and being retired. And we focus not just on the financial issues, but non-financial, things like health, longevity, relationships, cultivating meaning and purpose. So make sure you hit the subscribe button. We've seen over the last several decades this precipitous decline in interest rates, and it's had a huge impact in terms of how retirees and investors look at their portfolios, decisions that they've been making on their portfolios, and how things have changed. When I was in the trust industry back in the late 80s, it's pretty easy to find a 6 or 7% GIC return. In the early 80s, it was much higher than that. Now, we could argue that the inflation rate was higher, so the net return may not have been a lot higher than it is today, but there's something very satisfying about getting a 6 or 7 or 8% return on our risk-free investments. So let's take a look at where interest rates have been. The first thing that I want to talk about, though, is how you need to look at your specific returns. So this particular chart takes a look at various potential returns. The green star there is your specific return. So always need to be mindful that before we enter into a discussion on investing and the kind of strategies that we need to be pursuing, you need to first confirm what returns do you need to achieve to obtain the outcomes that you want for your retirement income plan. And everyone's different, and it really comes about through a series of discussions with your financial advisor, your retirement income specialist. As you do forecasting and then work back through your financial planning, they can confirm what kind of returns that you need. Now, it's very rarely when we talk to clients that they can actually achieve their financial goals getting risk-free returns. So if you look at 5-year GICs or 1-year GICs or high-yield savings accounts where you're getting virtually nothing, and certainly when you look at the impact of tax and inflation, they are getting nothing, quite literally, they're going broke safely, then they need to be looking at other strategies to achieve those goals. Some people do have enough capital amassed that they can go with a risk-free strategy, but most people need a bit of a balanced strategy or a diversified strategy to achieve their objectives. Now, this chart tells the whole story. If you look at the left-hand side of the chart, you can see the green line, which is the trending for interest rates over time. The blue mountain chart that starts on the left-hand side of this chart and then goes up slowly is capital. Now, basically, if you look at the top of the chart, it says how much initial investment would you be needing to generate $25,000 of annual interest income from a guaranteed investment certificate. That's the basic point. And if you go to 1982, at the bottom left-hand side of the chart there, you can see that interest rates were very, very high. Some of you may remember those days, particularly some of you might have been borrowing money for your home mortgage. They were very high. And you would have needed $155,000 back in the early 80s to generate $25,000 of interest income. Now you can see that interest rates slowly were going down over that time period. Now this chart goes to 2014. I'll show you a more up-to-date one in a second. But if you look at 2014, you can see that the blue portion that's going up, up, up through the right-hand side of that chart, that's the amount of capital, we needed in 2014 in excess of $1.2 million to generate that same $25,000 per year of interest income. So we went from $155,000 of capital to $1.2 million plus. That's the real issue that retirees have been struggling with over the last number of years, is the very low purchasing power on their fixed income investments. And so when you look at this issue, it even is more compounded when I look at the update to this schedule. Again, this is updated if you look at the chart, the red, which is 2019, and we're up to 1.4 million in 2019. We needed 155,000 in 1982. It's astounding the differences. So there's a few key principles that you need to keep in mind. So first of all, none of us want to take on more financial risk than is required to achieve our returns. The second thing, though, that we need to understand is that when we talk about risk, when we build portfolios, we're not talking about seeing money going down and then never returning. We're talking about buying very high quality investments to construct a portfolio that over time has a very high probability of delivering the results that we're looking for. It's all about diversification. And the first thing you need to do is determine what returns you need to achieve your goals. That is the first step then of defining what your investment mix is going to look like for those goals to be achieved. That will confirm how much you can afford to have in risk-free investments or guaranteed investments or bond investments, capital preservation investments, and then what do you need in more growth-oriented investments. Now, don't let the word growth scare you. When you're talking about growth investments, it could be investments that are buying financial services stocks. It could be health, life and health companies. You look in the Canadian landscape, you've got some great large insurance companies. The telecom sector, you've got the utility sector, and you've got large brands that are very dominant in the sectors that they operate on. Very strong balance sheets, great dividend payouts, and very, very good management. The way you deal with risks is, like I said, through diversification and time. So your financial plan will help to define how to balance those two things off. Again, the motto should be, don't take on more financial risk than is required to achieve your financial goals. And get feathering in growth in your portfolio so that over the long term you do achieve the objectives that you're aspiring to. There are a number of strategies that your advisor can integrate. Certainly we do that with our clients to reduce risk, to make sure that those clients have a high probability of achieving the outcomes that they're looking for. Anyway, I hope that you found this particular video helpful. Now, like I said, if you have not visited our YouTube channel before, make sure you hit the subscribe button so you get alerts to the content that we're producing. As well, we've uploaded some links to some other videos that we think would be helpful in your journey of exploring different investment options around retirement income planning. If you haven't gone to our website, make sure you get there. And of course, it's www.humphrieswealthgroup.com. We've got great content, and we're posting content to our blog post all the time. There's some great articles you'll likely find helpful. So all the best as you pursue your retirement dreams.